Welcome everybody to the Janus Weekly Insights. It's Friday, March the 12th. My name is Leslie Cliff. I'm here with Wayne Wachell, our other co-founder and CIO, Chief Investment Officer and CEO of Janus. Wayne, what happened this week?
Yeah, well, more good news. Number one, the Biden administration passed and signed the $1.9 trillion COVID-19 bill. Great news. And investors see that as actually jacking up global growth this year. And we're seeing forecasts by some economists in the US of 9% growth this year. That's the highest growth since the 1950s. And on the flip side, inflation was lower than expected, came out this week, and that's a good thing for now. And just today, the consumer confidence popped higher than expectation. So good news all the way around, I would say. And on that, markets hit record highs in the middle of the week, and value just kept on chugging along. Another good week for value, pushing up financials and energy. And tech, which had a bad week last week, rebounded this week smartly, and that helped push the overall market to new highs. So a pretty good week.
Yeah, I see the Bank of Canada also came out and we're torn with such good news short term, but still poor long-term, labor situation. So they've kept rates where they are as well. So
they've also mentioned too that they're going to maybe taper and stop buying government bonds or buying less of them at least sooner than most other central banks. So that was interesting news, I thought, in terms of that's a pretty optimistic perspective, I think, from them. They're very good, the Bank of Canada, I believe, in terms of compared to other central banks around the world. And so maybe they're a bit ahead of the curve here in terms of buying less of our bonds going forward.
I also not sure clients really are aware of the health of the Canadian government versus the US government. We're actually in much better debt situation. Maybe just our debt to GDP is, I forget the numbers, but better.
Yeah, it's, if you look at, we had a problem in the 90s with debt to GDP, and both the liberal and conservative governments they took care of that. And right now we're running around between 50 and 60% of debt to GDP. The US now is pushing through 100, on the way to 120. You got Italy at probably 180, Japan at 200 plus. So we look pretty good. We're in the same sort of ballpark as Germany, and that's pretty good. So, we've taken, there's been strong fiscal measures in the past, and so that's going to help us right now as we pile on more debt right now. That can't go on forever, of course, but we're in good shape, I would say, in terms of our balance sheet.
Now, Wayne, one other thing I don't think clients really grasp is when interest rates go up, and they have 10-year interest rates have gone from like 0.6 to 1.4, something like that. Some say on the way to 2% in relatively short order. What does that mean for the price of bonds?
Well, if you look at this year in Canada, our bond index is down over 4% year to date. And that's because yields have backed up like 60 basis points in the course of this year. So yields go up, prices go down. And that's why we've seen a lot of the tech companies get hit because higher interest rates impact them. They're called long duration stocks. So it's hurt growth stocks. But on the other hand, value stocks, they see the growth coming forward. They see higher earnings, and they've been doing very well and coming back. And value stocks, for example, this year are up 10%. Small caps have done really well as they see a stronger economy as well. They're up 18%. And the TSX is doing well this year. It's outperforming the S&P because banks are doing so well. We have a lot of banks in there. We also have oil stocks. So the economic sensitive names do really well when bond yields go up, and the growth ones don't fare as well.
I mean, I can't let this up. I don't do these videos every Friday. I can't let this opportunity of interviewing you go by without giving you a longer term question, which really interests me. Is you and I and most of our clients, we've lived through 40 years of deflation, 40 years of declining interest rates, and we're probably been through the turning point of decades now of increasing interest rates. And this is really, really profound. And what does it really mean to the backdrop of investing?
Well, I think we're seeing a sea change here. As you mentioned, 40 years of disinflation. I would argue that last decade, the central banks dropped the ball. They were too tight. We didn't get enough inflation. They weren't aggressive enough, especially the Europeans. And even the Fed, that Jay Powell has confessed to being too restrictive and not producing more inflation. So when you want your inflation, you need a little bit of inflation, but not too much. We haven't had enough inflation to keep the overall economy growing. And so it can be a good thing if it's controlled, but if it's out of control, then there's a problem. Then what happens is the bond market vigilantes come back, inflation expectations go up, and yields go up. And that's really a threat to everything longer term. Longer term stocks, if there is an inflation issue, we start looking for inflation hedges. And stocks are definitely a better inflation hedge than bonds. And so you want to keep your bonds short. You want to invest in more equities, more value strategies, more asset-driven companies that do well during inflation, and more commodities. We could be introducing more commodities into your portfolio going forward. That's a possibility. So it's a fine line. We hope there will be more inflation going forward. The question is, will it be out of control? I think 2-3%.
We're not saying it's going to be out of control. It could be a good scenario if they do a good job. But it is a change to 40 years of declining interest rates. And even if you come to financing your home, or like, it's just a backdrop of it's a different backdrop that you're making decisions in, and it's worth thinking about. So Wayne, what do you think is interesting that's going on out there?
Well, I think the big thing right now, it's on the back of my mind, is what will the central banks do? How will the central banks keep longer term rates down? They can keep short term rates down, but how can will they keep buying bonds? And yesterday, the European Central Bank came out and said they're going to buy more bonds. They're concerned about their bond rates getting too high, cost the government more money on their interest costs then, obviously. So will the central banks start buying more of those bonds? And how will governments react to a stronger economy? Will they tighten in their fiscal policy? They'll have lots of revenue, obviously. How will they balance that? So it's going to be interesting to see how that plays out in terms of, as we see this growth come through, what's the reaction of governments and central banks, and how do they react and try and keep interest rates low for themselves and for lenders?
Great. Well, that's a great way to finish it. We will report on all those issues as time goes by in our Friday Insight sessions. Thank you very much for watching. We're here in British Columbia. If you're here, we're very happy. Dr. Henry said 10 people can gather outside. So that's a big joy for me, particularly celebrating my dad's 92nd birthday tomorrow outside with many family members.
That's great.
Very fun.
Good stuff.
Anyways, see you next time. Thank you.